Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is Richard Bernoulli. Today we have Charles Hugh Smith, author, leading global finance blogger, and America's philosopher, we call him. He's the author of 9 books on our economy and society, including A Radically Beneficial World, Automation, Technology, and Creating Jobs for All, Resistance, Revolution, and Liberation, A Model for Positive Change, and The Nearly Free University in the Emerging Economy. His blog, of2minds.com, has logged well over 55 million page views and was at one time number 7 on CNBC's top alternative finance sites. Welcome, Charles.
Thank you, Richard. Always a pleasure to join your program.
Great. And thought today we'd do a discussion on what you actually wrote about recently is growing tension between the public sector and the private sector, in particular between public pensioners and the population that pays for that, mainly in the form of property taxes and other fees. And so this is happening all over North America, this growing tension, likely to result in a growing pension crisis across the continent, also globally too. This is a global problem as well. And just wondering your thoughts initially on that from your recent writings.
Right. Well, thank you, Richard. I think it's a topic that has been suppressed by the mainstream media because there is no easy solution. In other words, so the authorities in charge of the pension funds have tended to downplay it by claiming they're going to make it up with very high returns on capital and other kinds of painless means, but the reality that's now becoming visible is the public pensions have to be funded at rates that require the cutting of public services. So there's a seesaw here, that the more money that's put into the public pension funds to build up their capital to the minimum levels, then the less money is available for public services. So it's a win-lose situation or a zero-sum game. You can't find money for both. And as the asset bubble economy that we've been living in for a decade, as that normalizes or perhaps even declines, then this is really going to be a case where many municipalities and counties are going to be the proverbial tide goes out and we see who's naked.
Yeah. I mean, many of them have built-in assumptions of trying to get 7% to 8% yields in order to meet stakeholder obligations. But as you know, with financial repression, the repression of interest rates to low values has made it difficult to get yields on a big part of their holdings has been in bonds, and so as yields have gone down, it's made it very difficult, for the pension funds to meet their yield goals. Yeah.
Right, and then in what's been their response? If you're one of the fund managers, then you're piling into the FANG stocks, right? You're piling into Apple and Facebook and Google and Netflix as the only way to get those kinds of huge returns that are required to keep the funds solvent.
Yeah,
and then we know what happens is these FANG stocks are a tech bubble we've seen before in 2000 and 2008. And so these pension funds are exposing themselves to tremendous risk, way above that of buying 30-year treasuries or AAA rated corporate bonds, which, as you say, was the normal haven for their safe positive returns. Well, they're exposed to a lot more risk, and so they could they could end up suffering tremendous drawdowns as if bond yields continue to rise. Then, as we know, the value of the existing portfolio in bonds declines accordingly. And if the FANG stocks ever roll over and decline, then that's going to hit a lot of these pension funds that have counted on technology companies to make up for the lower yields you described.
Yep, and they're already warning on that in terms of what could happen otherwise. What could be their response. For example, just recently, the Ontario Municipal Employees Retirement System, OMERS, which is actually Canada's largest defined benefit pension plan with about $95 billion in net assets. They actually put on their website that deficits will be funded through a combination of contribution rate increases and benefit reductions. So they're already warning, either there'll likely be more higher property taxes or cut in benefits, to the actual pensioners.
Right. And let's, maybe we can put some numbers behind these statistics, these dynamics that we've been discussing. And I have a couple of charts here I submitted to you before we started recording.
Yes.
Well, and the first one is shows that the taxpayer contributions into government pensions, and that means public sector pensions, has more or less doubled in a decade, from 60 some billion annually to over 121 billion, and that's skyrocketing. The rate of increase is far above the rate of the growth of the overall economy. And so in consequence, like to raise these sums, then municipalities, states, and cities are raising property taxes. And I have a chart here of King County, which is Seattle municipal area.
Mm-hmm.
And the property taxes there are up 43% in 4 years.
Wow.
43%. And anecdotally, I just heard someone report that their taxes in the Seattle area went up 26% in 1 year. Now that may have been local taxes on top of the other property taxes, but 43% in 4 years, that's a more than 10% annual gain there. And most people's wages have gone nowhere. And right. I have a chart here that's dated a few years, but nothing really has changed. Mm-hmm. And it basically it shows that the bottom 90%, when adjusted for inflation, the bottom 137 million households in the U.S. have actually lost income, when adjusted for inflation. So that people the vast majority of households that are property owners are not making more net income here, and so they're having to cut their other spending in order to pay these skyrocketing property taxes.
Yeah, exactly. And you also had some other charts in here as well on how on the other side of the fence the government pensioners have been paying themselves very lavish pensions, awarding themselves, which actually only makes the whole problem worse.
Right. This was a chart from a Sacramento Bee article regarding the Sacramento area's fire department's highest paid pensioners. And there's people, a number of these people are earning over $200,000 a year in pensions.
Wow.
Now, $200,000 household income will put you in the top 5%
right.
of American households. In other words,
Yes.
This is an extraordinarily high income. And the number of pensioners in the state of California that earn over $100,000 in pensions annually runs into the thousands of people. And so, there's a sense here of great injustice. In other words, the people who are paying, the majority of people who are paying property taxes have not seen their income soar by these extraordinary increases that the property taxes are going up by, nor do they have pensions in a six-figure range. And so it clearly feels like exploitation to those of us who aren't looking for $100,000 or $200,000 in guaranteed pensions. And so what this is doing is creating huge gaps in pension funding. And I had a chart here that showed an $18 billion gap in CalPERS, which is the largest public pension fund in the state of California. And we also see here, I have a chart of New York City pension contributions, which soared from about 1 billion, a little over 1 billion annually around the year 2000, and now it's pushing 10 billion. So you're talking about a tremendous increase, and the rate of increase continues. In other words, this isn't just a one-time bump up and then the pension contributions stabilize. They continue to rise at these rates that are 4 or 5 times the growth rate of the economy as a whole, and also of wages. So before the program, you mentioned, if we extrapolated these trends, where would we end up?
Yeah, I mean, in your recent writings, what you mentioned is the migration to lower tax jurisdictions, right? Like if somebody is living in Illinois, they may move to Florida. Can you elaborate on that?
Right. I think that what we, just to kind of set a context here, the context of what we're describing is cities and counties and states are under legal obligations to fund these pensions at the rates that were promised to the pensioners, right? And the only way out of those legal obligations is bankruptcy. And many states have unclear laws regarding municipal bankruptcies. In other words, cities and counties in many states, they don't have a clear pathway to declare bankruptcy. And so the only way that the cities and counties can raise the money to fund the pension plan is to cut public services. And so you're hit with a double whammy. In other words, your property taxes and junk fees are rising rapidly. Meanwhile, your libraries' hours are being cut, your police departments are being cut, and the roads are filled with potholes that can't be filled unless you pass a special bond. And so these places that are being crunched by these pension costs, the public is seeing a deterioration in their lifestyle, if you will, because the local infrastructure is crumbling, and there's no money to fund it because all the money has to go to the pensions. And so I call people who are stuck in these areas tax donkeys, because they're being loaded up with ever higher taxes, and it's difficult for them to escape in many cases, because their kids are in school, they've got family obligations, they can't quit their jobs, and so they're really stuck. But there are a very large number of people who tend to be high income who are mobile, and they can leave. They either are childless or their kids have left home. They work largely in the digital realm, so they can work from anywhere. And these people are going to migrate, and despite the claims of the status quo politicians in these high tax states like California, Illinois, and New York, that people don't leave. They don't leave if the services they're getting are keep increasing in quality and quantity every year. And so, in other words, the past is not a good guide to the future, because we've had an asset bubble-based economy for the last decade, right? And so municipalities have been scoring huge gains in tax revenues, which has allowed them to maintain services at a very high level and fund the pensions. But once there's a recession, then that goes away. And then the
Right.
public services are going to be slashed. And then so people like New York City and they like San Francisco and they like Seattle. But at some point, as homelessness overtakes their neighborhood, homeless encampments show up on their block and crime starts going up, property crime, petty theft, all that stuff. And all the good restaurants close because the taxes are too high for them to survive. All these reasons to stay in these high tax areas vanish literally overnight. And so we're starting to see anecdotally articles from people saying why I'm leaving Seattle, why I'm leaving San Francisco, why I'm leaving NYC, and we're seeing more and more of these. And so this migration, it's difficult to track. I mean, we know that there is a leakage of population from California, say, yeah, but what's not being captured is the nature of the people who are leaving. And I think if we could dig down into those statistics, we'd find that it's the most productive in terms of paying high taxes. It's those people who are leaving because they're the ones who are caught in the vice, right?
Yeah.
And so the people who are staying, who are left behind, are the less productive, the people who make less money, pay less taxes, and absorb more of the government services. So we can discern a very destructive feedback loops starting now. And of course, this feedback loop will only get stronger as when we finally get a recession, which is the high taxpayers are leaving for low tax climes and leaving the people who are depending more and more on the government services, which are going to be slashed.
Right. It seems to be an emerging negative feedback loop, as you mentioned, that is actually nonlinear, right? Because as these more productive citizens leave, then the ones that remain behind are actually burdened even more to make up for the loss, if you will. So it just gets worse in a nonlinear way.
Right. And I think that's an excellent observation, Richard, because when we think about small-scale entrepreneurs that make cities livable, and this includes restaurants, cafes, small theaters, and services for children and the elderly, all these public, private sector niceties, if you will, they're going to be under tremendous pressure as their customer base flees, right? And so then they start closing, or people that try to start a new cafe or restaurant quickly find they're not making enough money to survive as their tax rates go up. And so, and I personally am in communication with a lot of people through email throughout the U.S. where they're small businesses and they are just basically, their noses are just above the waterline. In other words, they're staying afloat, but just barely. And so there's a huge number of businesses like this that will create that nonlinear effect that you're saying. In other words, if property taxes go up another 10% and a recession causes a 5% decline in consumer spending in a city or a county, you're not going to see a 5% decline in small businesses. You're going to see a 30 or 40% decline.
Yes.
Right? It's a huge impact because there's so many people that are right on the borderline. And of course, we can also throw in other things, other factors which we can be fans of. We can support, like, say, minimum wage laws and these kinds of things. But again, they're accumulative. In other words, for the small business owner, it's like the property tax and the other junk fees, and then the minimum wage increase, and then the higher healthcare. These, if you add, each one seems to be like something we can say, well, they should be able to absorb this. But when you add up 10%, 10%, 10%, and 10%, then suddenly you've got increases of 40 to 50% in their fixed expenses, and they can't survive. So I think you're absolutely right. There's going to be enormous nonlinear effects as these feedback loops eat into the class that pays most of the property taxes.
And the idea that pension benefits could be cut. What do you think of that? I mean, just that alone could cause a lot of social unrest, right? If in terms of people not accepting that, not willing to accept those cuts.
Right. Well, we've seen some. So we have some examples, like the city of Detroit, where there was a successful municipal bankruptcy, and pensions were cut to what was actually sustainable with the existing pension fund. And of course, that created a lot of unhappiness in the pensioners who felt that they'd been promised X and were given half of X. But on the other side of the coin, in regions like California and New York and Illinois that are dominated, if you will, by public unions, then the war that's heating up will be from first the public pensions and the public employees unions versus the taxpayers. And in the current arrangement, the taxpayers have very little representation in the local government, right? They don't really have a voice. The unions have the political heft and the political influence, and so they're going to fight tooth and nail to keep the pension structure as it is. And so I think it'll require a political crisis, either a tax revolt of some kind, or the complete disappearance of all cash, to where the states, the counties, and the cities simply no longer have any money. I mean, their accounts have been drained and they have zero money to pay people. And until that point comes, then I doubt that the status quo will change. But I have a chart here, not really a chart, but a little text box here of based on Peter Turchin's work about the disintegrative forces.
Okay.
And he identifies integrative eras where people find reasons to work together, and then disintegrative eras in which they find reasons to disagree. He plots this on a political stress index, is what he calls it. And so I think what we're talking about here in the public pension and public sector versus the tax donkeys, we can see three of the key dynamics that Turchin identified in his work, one of which is stagnating real wages. As I said, for 90% of the workforce that's getting nailed with higher property taxes, their wages have not gone up in years or even decades, okay? And overproduction of parasitic elites. And I think, whether you want to call the parasitic elites public or private, I would lump them all together, but people pulling down enormous salaries at the expense of other people, that I think, however you want to describe it, I would call that an overproduction of parasitic elites. And then the deterioration in state finances. I mean, we see that counties and cities are struggling now in the second longest economic expansion in history, right? I mean, a tremendous expansion in stock markets and housing values, and this is the best of all possible times. And so if we're seeing cities and counties struggle with budgets now, then we can imagine what happens when we finally get a real recession. And so clearly we're seeing point three, the deterioration in state finances. So we're going to have this dynamic that we're discussing is definitely increasing the political stress index, and it's definitely going to create severe structural, social unrest and social discord.
Yeah, exactly. This is very interesting on Turchin's disintegrative forces. There's also the idea that as property taxes go higher, you begin to wonder whether you own the property, and the concept of property rights comes into question. I mean, is it the government owning the property and you're just renting the property from the government? When property price taxes get so high. Your thoughts on that?
Yeah, I think that's a great topic, Richard. And that before we started recording, you were mentioning the model of that goes back even to the Roman area when Rome suffered these disintegrating forces that Turchin describes, in which people simply abandon their property. They walk away from it because the taxes are higher than they can afford, and the property has lost its value because of this tremendous increase in the tax burden. And so, in my view, places like San Francisco and Seattle and Brooklyn, New York, and a lot of other places, people have tolerated these rapidly rising property taxes because their homes have gone up so much in value, right? In other words, you're talking about Seattle, $500,000 house a few years ago is now worth $800,000, and we see these numbers. So when you feel like you've made $300,000 in 5 years or less, then you feel like, okay, I can afford another $5,000 or $10,000 a year in property tax.
Right. Yeah.
But if that $800,000 house drops to $400,000 in the next recession, then suddenly all those people are going to start feeling that it's not so easy anymore to make those taxes. And even more recently than the Roman era, there have been times when cities have gone into decay and into this feedback loop that we've described, and Detroit being a famous example in that the value of houses fell to zero. And so, and you go, well, that's an extreme caused by an extreme depopulation and so on. But we have to remember, we're not talking just about the total value of the home. We're talking about the homeowner's equity. So if somebody buys a house for $500,000 and it drops in value to $400,000, and their entire equity was $80,000, they're now underwater by $20,000. So they can walk away, and they've lost nothing. So it depends on the debt burden that each of these homeowners has taken on. So that's how we could see even these high value cities start having people jingle mail their mortgage, because as the property taxes push to $15,000 or $20,000 a year, which is that's just absolutely standard in Northern California and many other of these high value places. And as you mentioned before we started recording, there was a news report that the Federal Reserve, one of the branches of the Federal Reserve, suggested a 1% basically wealth tax on all homes in Illinois to resolve their pension crisis. Yes.
Yeah, exactly. Already I know someone in Illinois is paying about 3.3% in property taxes, so something like $15,000 per year, over $1,000 a month on a house of approximately $450,000 value. And to add another 1% on that is the suggestion by the Chicago Federal Reserve to add a proposed 1% on property annually for the next 30 years, to cover the pension crisis problem in Illinois. So that was just recently proposed by the Chicago Federal Reserve.
Right, and so then that 1%, the additional $2,500 a year. Then you can imagine, as in a recession, and then there's even more, as we say, then tax revenues start drying up, and the public starts rebelling against the cuts in public services. Then there'll be another 1% suggested, and another 1%. Yes. And this is a dynamic that you mentioned earlier in the program, which is we can see the feedback loop here, that as tax revenues decline in a recession, then they have to raise taxes on those people who are remaining, who can still afford to pay taxes. Yeah. And another little dynamic here is, rents in places like Seattle are skyrocketing as well. And of course, from the property owner's point of view, if their property taxes are going up by 10, 15, 20, 25% a year, then they feel that there's no option but to raise the rents that they're charging on their properties. And so it doesn't just hit property owners. It eventually bleeds over and hits everybody in a municipality, renters and owners alike.
Yeah, it's interesting you mentioned how the property values in Detroit went towards zero. This has also been observed by Martin Armstrong, who sees Illinois as following the exact pattern as the fall of the city of Rome, the Roman Empire. What he mentions is more and more people just walked away from their property, for there was no bid. Illinois is the number one state that now has a net loss of citizens and people that are fleeing the state. Martin Armstrong writes, there is absolutely no hope whatsoever of fixing this problem of a pension crisis in Illinois, and every solution, like the one from the Chicago Federal Reserve we just discussed, will fail in the end. Martin mentions the state also has COLAs, which insanely increase state employees' yearly pensions by an automatic 3% annually, regardless of the inflation rate. So that's how crazy things have become. Martin also writes, because Illinois does not have its own currency, it is then bound by the national value and international value of the dollar. Like Greece, as the dollar rises, Illinois is thrown into deflation. Its institutions are broken, and they will be remembered only by history. When you plot the actual population of Rome, what emerges is a very interesting and a stark reality that applies to Illinois. People could no longer afford to live there, and they were forced to just walk away from their homes. The value of real estate went to zero. That's what Martin writes from the analogy with what happened in history with the city of Rome.
Right. And, I think one thing to think about in that model is that ultimately every government, every state function, whether it be a city, county, state, or federal, the government depends on the private sector to generate the jobs and the income that can be taxed to support the state and its employees, right? And as a general rule, the government in the U.S. Is around 20% of the workforce, right? So it depends on the other 80% of the workforce to generate the taxes to pay the 20% state employees. And so if you basically strangle your public sector or your private sector to where it's impossible to make money, it's almost impossible to start a business that's actually profitable, then what happens is you end up depending more and more on a few large employers, the way that Seattle depends on, it used to depend on Boeing, and now it depends on Microsoft and Amazon. And so what happens is these large corporations are also mobile. They're the epitome of mobile capital. They don't need to stay in these high tax areas. They can leave, or they can keep a sort of a facade of corporate presence, but they can move the 90% of their workforce elsewhere in the U.S. or in the world. And so I think once you become dependent on these very large employers and they move, then your city is absolutely gutted. And then you go down the Detroit path. That Detroit became far too dependent on one industry and a handful of corporations. And I see this as being extremely likely that Seattle and the San Francisco Bay Area that's dependent on really these leaders in the tech industry, once they go away or move elsewhere, then the tax base is going to be cut tremendously, because those are the companies that are creating the high income jobs that allow people to buy these overpriced homes.
Mm-hmm. And so ultimately you see sort of a combination of that with brain drain and wealth drain?
Right, exactly. As that the demographic, and we didn't really talk about this much, but as we know, millennials as a generation are already burdened with tremendous student loan debt, and with compared to previous generations, their earnings in their 20s and 30s is considerably lower than what was achieved by by Gen X and the baby boomers. And so the question comes down really to, if millennials want to marry and have children, unless they're both brain surgeons or CFOs of a company about to go public, or somebody earning extraordinary sums of money, like $250,000 each. That dream is not doable anymore in a lot of places. In other words, they can't marry and have children and have a decent life and buy a house. And so generationally, what we're going to end up with is we're hollowing out these very high cost locales, and we're leaving the baby boomers and people who bought their homes long ago and have a lot of equity, and but we're putting a lot of incentives for younger families and households to leave, because that's the only way that they can afford to own a house and have a family.
Wow, that's great insight today from Charles on that emerging pension crisis and the growing tension between the public sector and the private sector. Charles, how can our listeners learn more about your work?
Yeah, please visit me at of2minds.com. And thank you very much, Richard. Always a pleasure.
Great, excellent. We'll end it there and do another one next month.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.